right now. All right, welcome. This session is going to be recorded. Please take notes, anyways. But if you don't understand something, you can go back. It's going to be on YouTube and probably on Twitch, as well as on my Discord. So you're going to be able to go back and watch it again. I advise you to do that, actually. We're going to try to keep this relatively short, just to, not to overload you with information, and keep it as simple as possible, less technical, more practical, as promised. And thanks for Delta Exchange for making this happen. And thanks, Anand, now for joining us. He's the research analyst from Delta. He's going to be guiding us today. And I'll let Anand take the conversation now, and let's get to it. And just a quick note: none of this is financial advice. This is just for educational purposes and to have some fun. All right, Anand, you can take it over now.
Thank you, Conqueror. Thank you, everyone, coming for this session. And I'm sure that after this session, we'll be definitely generating alpha in our knowledge of the options. So this is me, Anand Raj, and you can find me on Twitter at AnandJSSME. So Delta Exchange is basically a crypto for crypto options, where you can trade call, put options of BTC, Ethereum, Solana, and many more. Perpetual futures of BTC, Ethereum, and 150 altcoins are available on Delta Exchange.
Anand, we don't see your screen, I guess, if you're showing anything, by the way. Just letting you know.
Oops, my bad. Okay. Thank you for.
No problems, mate.
So myself Anand Raj, and I am research analyst in Delta Exchange. And so Delta Exchange is basically the home for the crypto options. In options, call and put options of BTC, Ethereum, Solana, and more are available for trading. Perpetual futures of BTC, Ethereum, and 150 altcoins are available for trading on Delta platform. Below you can see the 24 hours options volume and the futures volume of last 24 hours and the last 7 days. I just want to put up a friendly disclaimer. This presentation is just for the educational purpose. Delta Exchange doesn't provide any trading ideas, trading setups, or any research. So before taking any positions, please do your own research and consult your financial advisor.
I just want to
Present.
mention something here. The Delta is one of the biggest players in the options, crypto options category, just to let you know. And we're at you, Anand, again.
Cool. So presenter, organizer, distributor of this PPT, presentations, document in any form is not responsible for any profit or loss. So first question comes, why crypto market? Because we are discussing about the options of crypto. So first question is, why crypto market? So the reasons are very simple. This is very highly available. It's a 24 hours market, 365 days a year. There is no holiday. There is no boundaries of any sort in this market. Two free tools are available to analyze the charts of crypto underlying options as well. There is a good amount of liquidity as it is traded across the globe. You can buy the cryptocurrency when you think it will rise. You can sell the crypto if you feel that it is going to fall. So people have freedom to buy as well as sell. And there is a high potential of high returns, high gains from this market, since it is mostly highly volatile. So this slide I've just tried to cover the volatility of the crypto market. So this is done through ATR. ATR means the average true range, which measures the volatility in the market. The first two underlying I have picked up the Nifty 50 and the Bank Nifty, which are the index of the Indian market. So the Nifty 50, if the ATR for 2022, it is somewhere close to 1%. For 21, it was close to another 1%. Bank Nifty, it is somewhere close to 1.5%. In 21, it was close to 2%. Looking at Dow Jones, which is 1.8% for 22 year. In the last year, it was 1.4%. Nasdaq, if we look at it, is somewhere close to 2.2% ATR, and for 21, it was 1.8%. Coming to BTC, the ATR for 2022 stands at 8%. For year 21, this ATR was 7%. For Ethereum, the ATR for 22 is 8%. For 21, it is 8%. From this, it is looking as if BTC and Ethereum are the ones with maximum volatility. Let me allow people who are joining the meeting. Yeah. So completely, it is completely conveying us the picture that this is BTC, Ethereum across these major global indexes. They are the BTC, Ethereum are highly volatile, and we can see big range of movement in these. So now comes why options trading in crypto market, or what are the benefits of using options for trading in crypto or any asset classes. So first thing, the options was introduced for the purpose of hedging. If we are having the underlying in cash or spot, there might be a risk on short term basis. So to mitigate that short term risk, one can hedge the position through options. We will definitely discuss this in detail through a practical experience as well, through an example of BTC Ethereum as well. In options trading, the cost of holding is reduced. Just let me allow the people to join in. So the cost of holding is reduced in option trading. So it means to say, when you hold anything in spot, you need to pay the entire notional volume or the notional value of that particular underlying. When you are trading in futures, you pay a part of it still, but in options, you pay very tiny portion of that underlying value, which is called as premium. What is premium? We'll discuss in detail. We'll just try to go simple and easy so that we all are on the same pages. One important benefit of options trading is dynamic leverage. Okay. So, what is dynamic leverage? We will cover in very much detail. So, this dynamic leverage is a very fancy concept in itself, which tells me or which helps us to hold more number of shares when we are right and to hold less number of shares when we are wrong. So, this is something which options have an inbuilt feature, which is dynamic leverage. We will discuss in detail through a detailed example as well. Options come with a options data, which are a very crucial indicators for the market and which can determine the next move that can come. So options data is very handy and helps predict the market. So I'll take you through the screen of the Delta Exchange option chain, where we have the options data, which is a lead indicator which can help us know the direction of the market. People generally look for the clues in the market. If someone can tell us in advance what could be the potential next move through an event. So last few hours back we had a big event, and how I tried to read those indicators and tried to make an advantage of the options data. So I'm just taking you to the page of Delta Exchange, to this option chain. You can see this is the option chain of BTC right now. This is the expiry. I'm just coming to 16th of December. So let's not jump into these all stuff. I'll slowly and gradually take you to those part. What just I'm trying to convey, that options data convey a lot of things, and which I'm trying to take you through. So as you can see, in this entire option chain of BTC for 23rd December expiry, the heaviest option open interest was built at 19,000 call. As you can see, the highest bar in this entire column is at 19,000. Let me allow someone to join. So as you can see, the highest open interest was at 19,000 call. So what I did, it's just my research, it's just my reading in previous market. I'm not recommending anyone to go and sell options right away. So we'll first learn it, and once we are thorough with it, we can definitely take the trades. So this is the candle of the last, I'll just make it one day, and you can see this is the candle of the last day. I'll just pop it out, I'll try to make it a bit large. This is the candle of the last day. You can see the option chain was indicating that 19,000 is having a high open interest. So if anyone was about to sell the option chain or the call option of BTC around this area of 260 or 250, it hardly took 30 minutes from coming to 260 to 160 or even 120. So it was a fall of 120, or it was a wash of 120 premium in the options of this. And this idea we got through this option chain, which I'm trying to convey, that options come with the options data, which is very lead indicators. And definitely no hurry, we'll take this option chain options data in detail, and we'll definitely try to be one step further from the market through this important piece of information, which
Yeah,
is
guys,
free of cost.
don't worry about that right now. Anand just showed you how you can use the data as an indicator. So we'll do more examples for that, and yeah, don't worry about it right now.
So the next benefit of options trading is very high potential of generating good returns from options. The reason is very simple. Since we put less margin, since we put less capital in options trading in comparison to spot and futures, the potential of high returns increases. Since our margins capital is low, the returns increases. So now the options, generally we have two type of options which we generally all must have heard of: call options and put options. So I'll just try to make it very simple for you guys, what is a call option and what is a put option. I'll also try to explain you in the simplest form possible through an example. So options, we have call and put options. You buy call option when you feel the market will go up, or your underlying is going to go up. Let's say your view on BTC is bullish, you go and buy call option. This is not my recommendation right now. I'm just saying, if your view is bullish on market, you can look to buy call option. If your view on the market is bearish, you can go and buy the put option. So let's say if anyone is having a bearish view on a stock of, let's say, XYZ stock, so people can go and buy the put option of XYZ stock. Let me allow people to join in. Okay, no one.
Anand,
Cool.
can you make me admin so I can deal with that participants and you can go
I
on with
can
the.
do. Can you please help me out from where I can, or Neeraj can also help me out with that if it is possible.
No, I mean I can if you give me admin something, admin controls. Yeah, I
Not
don't
sure.
I don't want you to get disrupted from the stream. I can let people in.
I don't understand. So, Neeraj, can you please help me if it is possible to make a Concur admin? By the way, guys, here we have Neeraj on the call with us. Neeraj is the head of marketing of Delta Exchange. Conqueror, I am not able to figure out that. So
All
let's
right,
do
man.
it
It's
later.
just yeah, let's go on.
So for buying the call options and the put options, there is some premium which one has to pay to the exchange, to the platform, or to the market makers. So what is this premium? We'll discuss first with an example so that I don't want the things to be get complicated for you. So let's say Conqueror has come to get news from his sources that there is likely to be an announcement of a airport near his city. See, he got to see a land over there which he is looking to buy with the expectation that there is likely to be construction of a new airport in his city. So Conqueror goes and meets the seller of the property and says that I want to buy your land, but not right away. I want to have a contract with you, and in the next 3 months, I will come and buy your property or your land at, let's say, $10,000. Okay, it was a very small piece of land which Conqueror uh, offered to buy at 10,000 US dollars. Seller of the land says, "Why should I wait for you for the next 3 months?" So Conqueror offered him 1,000 US dollars. I'm giving you 1,000 US dollars right now. I will buy your property at $10,000 in 3 months with a fixed price of 10,000 US dollars. So in this case, Conqueror is bullish on the land. So he has paid 10, he has paid 1,000 US dollars. So this small amount which Conqueror is paying to the seller, since he is the bullish on that property, he is bullish on that particular land, which may go up because there is a likely event that is going to happen, which is the construction of announcement of a new airport, because of which the land property can go higher. So Conqueror doesn't mind paying a small premium. The $1,000 which Conqueror wants to pay to the seller is premium. So $1,000 which Conqueror is paying is the premium for that underlying. That underlying is the land of $10,000. So the $10,000 is the underlying value. $1,000 which Conqueror is paying to the seller is premium, and he's taking 3 months of time. So this 3 months which he's asking is the time for this particular contract. And after 3 months, if Conqueror doesn't come and buy the land, that $1,000 will be non-refundable because that will be part of the contract. So the expiry, so options, we when we buy when we buy options or when we sell options, we have to come with three things. One is the strike price, one is the expiry of underlying. So the expiry I've already told, 3 months which Conqueror took from the seller is the expiry of that contract. So this scenario where two buy one buyer and one seller goes into a contract. So the buyer pays a small amount to the seller, which is premium, and there is a time limit for that contract to be valid. Now coming to the actual scenario of call and put and the options trading, let's try to understand now the premium. So we pay a small amount which is called premium. So what is this premium? This premium in itself has two components. One is the intrinsic value and the other is the time value. The intrinsic value means the real value of that options premium or that particular option. What is intrinsic value? I repeat, intrinsic value is the real value of that options. How to calculate the intrinsic value? Let's say you have chosen a strike of 18,000 and your underlying is 18,500. So your intrinsic value is 18,500 minus 18,000, that is $500. Okay. Let's say your strike price is 18,000 and your underlying value is 17,500. So will there be any intrinsic value? Guys, I need the answers from you.
You can use the chat, guys, for answering. Come on, don't be shy. There's no right, wrong answers. We're just try to get more involved. It's gonna stick more.
Anand, can you repeat the question, please?
And we don't hear you, mate. Probably you muted yourself or something.
Oops. Oh, I don't know.
Yeah, we can hear you now.
So I'm asking, when the underlying is at 17,000, I'll take a real example. The underlying, which is BTC, is currently trading at 17,838 right now. And for 18,000 strike, if I choose 18,000 strike, what is the intrinsic value in this strike? Can anyone help me out with that? Anyone, guys? You said 17,500 and 70,000. Stefan, do you want me to repeat the question again?
Yeah, go ahead one more time. I guess maybe people missed it. Your mic is off again, mate.
If I'm choosing a strike of 18,000 and my underlying is 17,500, what is the intrinsic value in these options? Stephen. Awesome.
Since you are already paying 500 as your premium, then there's nothing that you're gaining here.
Okay. So this is the right answer. 500. Cool. Cool. So I guess we are almost on the same page. So this is very clear. To calculate the intrinsic value, just minus the spot price or the current market price of the underlying from the strike price, you will get the intrinsic value. And if you don't get any value, that means you have the option which is out of the money. So we'll come to that, what is out of the money. Let's not jump to it. So options premium, as mentioned, has two components: intrinsic value and the time value. Intrinsic value, I repeat, is the okay. Intrinsic value is spot price minus the strike price, and whatever component is left after this intrinsic value from the premium is your time value. I repeat, whatever is left from the premium after reducing, after subtracting the intrinsic value is your time value. Are we good? So in this case, when I was showing the screen of delta option chain, since 18,000 has no intrinsic value, as everyone told me, okay, 500 it had the intrinsic value, okay. Sorry, not this guy. Let's say if I'm choosing this guy, 17,000 strike. So the underlying is at 17,838. So this premium is having a intrinsic value of 838. So current premium is 1042. So 1042, which is the total premium minus the intrinsic value, which was 838. Leftover is 204. This is the time value in these options. Are we good on this? Or should I take one more example to know the intrinsic value and the time value? Guys, are we good? Or should I take one more example? Add one more example. I'll take it. Cool.
Do one more, mate.
Cool. So this is the underlying Ethereum which I have chosen. So let me get on to expiry, some other expiry. So you can see the Ethereum underlying values at 1323.64 right now. Let's say I'm choosing 1350, or let's say I'm choosing 1300. So what is the intrinsic value in this? 1300, and the current market price or the underlying value is 1324. So it is 1324 minus of 1300. So this is, sorry. So will you guys agree with me that 24 is the intrinsic value in this, which is the real value of this option? So 24 is the intrinsic value, but the premium is 43.6. So 43.6 minus 24, which was the intrinsic value. The left is 19.6. This 19.6 is the time value in this option. Clear, guys? Just give me a thumbs up if everything is okay. We guys on the same page. Cool. Because I want to make this options chain, options trading as simple as that. And believe me, you guys gonna love it. You guys gonna try it out, because it's very simple and it's easy to make money through options. It's not that tough. So once your concepts are clear, once your basics are clear, it's gonna be the easiest path and the simplest way of making the money. I'll repeat just in a short while. Options, we have options call and put. We buy the call option when you feel the market is gonna go up, or when you feel the market is bullish. You buy put option when you are bearish on the market and you want to sell the underlying. So selling the underlying in futures or in spot, if you want to play it on options, you need to go and buy the put options. Options has, for buying the options you need to pay some premium. Premium has two component. One is intrinsic value, the other is time value. In intrinsic value, if you want to calculate how much is the intrinsic value, you just need to minus the strike price from the spot price. Spot price means the current market price of your underlying. Whatever premium is left after reducing the intrinsic value from the premium, that part is time value.
And guys, don't worry about the. I understand what you probably been asking. What we're gonna do with this time value? Don't worry, it's gonna be explained later. Just know that where it comes from. Okay, just know that it's there for now for the session, and we're gonna go in depth with that. And as Anand said, there is two sides. There is a call side and there is a put side. If you think it's bullish, you buy the call option. If you think that your view of the market is bearish, you buy the put option. You're not selling anything. It's a different thing. Okay, you can buy and sell call options. You can buy and sell put options, but don't get confused. We're talking about the buy side. So if the asset is gonna go up, you buy the call option. If you think that the asset is gonna go down, you buy the put option. Okay, just this is the summary, let's say, of this page. Okay, just don't get confused and just know where these come from, and we're going to go in depth for each of these.
Cool.
Yeah, you can
And
take
just
it over.
guys, just one line. Uh, how to calculate the options premium? What is intrinsic value? What is time value? As a trader, we need not to calculate it, and it's not our role. It will be just you. Since you are an options trader, you should be knowing it. That's it. We cannot do anything in time value. We cannot do anything in intrinsic value. It has nothing to do with our options trading. It just being an options trader, we need to be knowing so that we can be a good player. Simple. Just know it and forget. Simple. Conquer, let's move to the next slide.
Yeah, sure.
So we generally hear of moneyness in options contract, which people speak of in the money, ITM, at the money, ATM, out of the money, OTM. So I'll make it the best simple possible for you. In the money, when I say in the money, means your market price is above your strike price. That means you are making the money. I repeat, in the money case scenario is when you are, let's say you have a call option and you have chosen, let's say, 18,000 strike, and the market price is trading at 18,500. So definitely the strike which you have chosen is lower than your market price, or rather telling the other way around, the market price is above your strike price. So you are making a huge money because you are in the money. So from the name itself, you can understand in the money scenario is when your chosen strike is below the market price. So you start minting money for every move in the underlying. I'll take with an example as well. So we are not hurrying up or we are not trying to rush fast in this case. With
But
example, we'll try to understand.
Anand, you're talking about this example is for the call option, right? It's not the
Right,
same
for a call option.
for put option
option.
because it's the opposite then. Because since
Correct.
we're betting on the downside, to be it in the money, then for the put option side, it should be lower than the strike price, because
Right.
it basically means that your strike current price is making the money, the right. Okay, you take it out, but it just this is for the call option because we're expecting the price up. So the strike is X and the current market price is above. Then it means that it's in the money. You're making the money. Okay, you're on the positive. But on the put option, it's going to be the reverse because then put option we're betting on the downside, and that's why the underlying price should be below your strike price to be in the money. Okay, so sorry for cutting you. It's usually confusing this thing, so I have
Yeah,
to
no
talk
issues,
about it.
Conqueror. It's good that you are helping me and people around. So next moneyness of option contract is at the money, which people call it ATM in short. So at the money scenario is when your strike price and your spot price is exactly the same or almost the same. What I mean to say that you have chosen 18,000 strike and your options and your underlying is also trading at 18,000 or near to 18,000. Okay, that case scenario is called as the at the money. Out of the money scenario is the case, let's say you have chosen a strike of 18,000 and your underlying is at 17,000. So you will make the money. In the case of call option we are speaking right now, as Concurrent mentioned, in call option we make the money when our underlying starts moving upside. So in out of the money, you have a strike you have a strike which is not very close to the market price. So in this case, you are out of the money. You are not making the money. So let's not try to read or remember these names in a very documented way. Let's be very familiar with them because it's gonna be very handy for us. We're gonna speak in this language. This is the language of options trading. So we need to not mug it up. Rather, we should be friends with these names. In the money, at the money, out of the money. The name itself says in the money, that means you are making the money. At the money, you means that you are sitting at the money right now, or you are at the ATM and you can make any amount of money you want to. It is just a matter of if your underlying performs right in your directions. And out of the money is a scenario when you are really very out of the money and there are very thin chances that you might make money
Yeah,
in
guys,
options line.
just get familiar with this terminology, because you have to know these. But we're gonna be as I said, in the following sessions, we're gonna go and show examples how these work and how they look on graphs, okay, on charts. So don't worry about it. Just know what they mean. Okay. Okay, Anna. Thanks.
Cool. So in out of the money as mentioned that our chosen strike is very far.
Your mic is gone, I think. You're muted. We don't hear you, mate.
So these options which we have covered, these call options and the put options, how these premium comes and how these premiums increase or decrease. These are governed through some Greeks, and these Greeks are delta, gamma, theta, vega, and rho. Believe me, guys, these are very simplest thing. The name may be tough, but once you understand this, it is gonna be very simple thing for us. So the one Greek which is delta, the name itself has the beginning with letter D, which I try to remember with the name direction. So delta is the Greek which will change the options premium in comparison or versus the underlying. So if your underlying is changing in the positive direction, in case you are having a call option, your delta will increase your options premium and your new premium will increase and you will win the profit. Okay. The next Greek is gamma. So the role of gamma is to accelerate delta when you are right in direction. So the delta will increase when the underlying moves in the direction which you focused upon, which you predicted. Let's say you predicted that BTC is gonna go up from 18,000 to 19,000. So you bought a strike of 18,000 call option. So if BTC starts moving from 18,000 to 18,200, so your direction is right because you predicted a bullishness in the BTC. Since the direction is right, delta will increase in your options premium. So you will in the profit. So next day, if the BTC moves from 18,200 to 18,400. The new delta will increase the premium, and this new delta which has increased will increase because of gamma. So gamma will increase your delta, which people call as gamma's role is to accelerate or decelerate delta. We will discuss this in very much detail with an example. And guys, believe me, in options trading, this is not gonna play a big role. It just being an options trader, we should be knowing what are the things that are affecting my options premium. Once you know that what is the backhand which is controlling my profits and loss, it is gonna be a big fun playing in options, trading in options, because these Greeks are the one which will be responsible to make our position in profit or loss. So we need to be designing our position in such a way that these Greeks become our friend. Rather than be they hurting us, they should become our friend and help us in increasing our profits scenario for options trading. So next Greek, which is theta, which is time decay. So in options premium, as I mentioned earlier, the premium has two components, the intrinsic value and the time value. So this time value component start decreasing, start reducing, start eroding on each and every single day that passes on. So theta is the Greek that is responsible for changing the options premium over the time. The next very important Greek, and believe me, this is the most and most important Greek, which is Vega. The name itself says Vega. The V of the Greek is volatility. So your options premium will change as the volatility in the market keeps on changing. When I say volatility, so volatility is basically the participation of people. As more and more people participate in any market, the cost of that underlying of that particular market increases. Let's say if you go to a market and there is a huge demand for any particular commodity in the market, we guys all are facing a problem of oil throughout the globe. Why? Because there is a huge demand for oil. The similar case happens with market as well. When there is a volatility in the market, when there is a FOMC meeting in the market, when there is a RBI meeting in the market, people participation in the market increases because some of them believe that it's gonna be good for the market, and some of them believe it's gonna be negative for the market. But this participation of people, which is slightly abnormal from the other days, increases the options premium. So Vega is the Greek which is responsible to increase the options premium when the volatility increases. Vega is the Greek which is responsible to decrease your options premium when the volatility decreases in market. The example which I showed you right now in the beginning of the session, where the options premium of BTC 23rd of December for 19,000 call, which was 250, 260 last night, a few hours back, came down to 130. So what happened? Did the BTC fall in the yesterday evening? No, not at all. Look at the price of BTC. BTC has not fallen at all. Not even 1% fall has been seen in BTC. What made these options premium fall to more than 60-70%? So guys, the answer is this: Vega. This is the guy. And believe me, as I mentioned, Vega is the one which is maximum, which has the maximum role in making position in profit and loss. And so this is the one which has a big role in options premium. As you can have seen just in few hours, the volatility has decreased in the market because one big event, which was CPI print, has gone out. So people participation has slightly decreased. But since we have another meeting tonight, which is FOMC, we are gonna have Fed interest rates today. The volatility is still there in the market. If this event would not have been in the market, can say this premium would have gone to 90%, which Conqueror has seen in his life as well. Once the events are over, the premiums wash low, the premiums are vanished like anything. It's like, a balloon filled with air. You plug in one pin to the balloon, and the entire air will not take even 1 second. In fractions of second, the entire air of that balloon will go out in the atmosphere. Same happens with the options premium. It just need 1 minute to wash your entire premium when the IVs are high and once IVs start cooling off. So this is what the role of the Vega is. We'll discuss this in more detail with a practical example. So we are on the same page and we capitalize or we try to understand this, which can help us in options trading. The other Greek is rho, which is based on the interest rate. So when the interest rate increases, your options premium also increases, and when the interest rate decreases, your options premium decreases. So this comes from rho, which is one of the Greek. So I'll just try to revise for you. Five major Greeks. Delta is for direction. The name D comes from direction. The another Greek is gamma. Gamma's role is to increase or accelerate or decelerate delta. Next is theta. Theta is the time decay. Theta starts with with letter T, so it is for time decay. The next Greek is vega. Vega means volatility. So volatility impacts takes place through vega, which is a Greek. Rho again the starts with R. R is the interest rate. So rate change in the interest rates will change your options premium. So I'm just trying to make it very simple for the first session. I don't want to rush out to more practical or more complicated options trading right now. We have a lot of things to cover in the next session where I'll be taking a practical example how the delta, gamma, theta, vega, rho plays a big role. As I showed you completely, this is the miracle of vega. And I'll show you the miracle of delta, gamma, theta, vega, and rho in the next session.
Yeah, thanks a lot, Anand. So what do you guys think? Is it as hard as you thought it was? I mean, a world of options is can be super technical and super deep, but the thing is, guys, don't forget, you don't need to know 100% of a subject. Just you need the 20% that will make you the 80% of the results. So that's what we're aiming here for, with the help of our friends from Delta, and thanks to them for making this happen again. I think this was a big issue that when people want to get into options, they're intimidated by the lingo, by the terminology, by the so many different variables in there. But the thing is, what we're aiming to do here with Anand is to simplify it as much as possible and make it available for everyone. I hope we achieve that. That's why your opinions means a lot at this stage. Yeah, this is basically the foundation, the core terminology that you need to know, and we're gonna go in details in the following sessions. And with examples, everything is gonna all blocks is gonna fall into right places, hopefully.
Yes, Luisa, there are gonna be more sessions on the next session is slightly gonna be one step further from what we have ended today. It's gonna be discussing more in detail and trying to tweak these Greeks to our advantage. And we're gonna be friends with these Greeks now.
So, guys, the thing is, yeah, this is the first of the sessions, as Anand says, but we're gonna do more practical side of it. This had to be a little bit technical because we wanted to introduce you the terms that we're going to be using in the next session, so you have the foundation. But from now on, we try to do more practical and less technical, so you can see the real live examples with Anand's help. And I think everything is going to make more sense after each session. So don't feel bad if if you're just confused right now. Watch it again, because it's recorded already. I'm gonna be sharing it soon, right after this, in YouTube. Just watch it as many times as you want. Prepare your questions so we can answer them in the next sessions. Get ready, and we'll take it from there. So I think that's it for now. We kept it under 1 hour. And thanks, Anand, for all the thanks for your time and for the knowledge you shared with us. And again, big thanks to Delta Exchange and our friends at Delta for making this happen. And see you guys in the next one. Please prepare your questions. Watch it again and again. And it's going to be, I promise you, it's going to be super simple, super smooth voyage. Okay?
Ivan, since you joined very late, Conqueror will put this entire recording on YouTube and other platforms. So please go and watch it out. In next session, I'll take 5 minutes of revision. And whenever you have doubts, you can definitely ask over there as well. Cool.
Yeah, exactly. All right, guys. Thanks for joining in, and see you in the next one. Peace out.
Bye, guys. Thank you for coming.